Welcome back. You're watching Stock Watch with me, Zinati Guma, and joining me to unpack your stock-related questions tonight are Devin Shutte from the Rebay Group and Nick Crail from FNB Wealth and Investments. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. It actually just dawned on me about 2 hours ago that we are in the last week of the first quarter. How fast did that go? Starting with you, Devin, was the only thing that was really fast in this quarter the tech stocks and the chip stocks.
Yeah, it seems like it, doesn't it? It feels like we've been watching this magnificent seven story unfold and watching global central banks. I mean, yeah, the magnificent seven still continues to perform, but I think it's getting quite interesting because there's quite a dispersion now if you kind of look at the underlying stocks within that, right? You can't just buy them all and hope for the best. The top performer this year, Nvidia, is up, I think it's around 80%, and the laggard being Tesla is down over 30. So you've had to more and more be selective in your tech picks, and I think the market's really trying to kind of tease out what the growth potential for these stocks are. But I think the counter to that is investors are starting to get more circumspect on the valuations and what they're paying for these investments. So yeah, it's been a fascinating part of the market and definitely kept us busy for the first 3 months of the year.
Yeah, quite interesting what you said, that you have to be selective, and also that investors are they're very aware of the high valuations that we are seeing at this point. And actually earlier on I was speaking to an analyst who was doing some tech analysis there for us, and he actually said he's shorting Apple. And Nick, just on your point, because the general sentiment was that it feels like we are in a bubble, and of course that's bound to pop at some point. Do you think that it is time to pop the bubble on tech at this point?
No, I don't. Pretty simply, I do think it's very important to, as the point has been mentioned, it's all about the underlyings per company. To amorphously kind of say they're all together, they're all technology stocks, and they've got the same drivers with the same sort of profitability metrics or cash flow balance sheets is just false at the end of the day. One definitely needs to have a look at the individual sort of investment cases, I think, for each stock relative to its current valuation, relative to its past valuation, and what sort of is driving growth potentially, because that's what you're often purchasing in technology is future growth. And so is that growth actually materializing? Is it not? Is it wing and a prayer? There's certainly a lot of analysis that needs to go on. But if we look under the hood, I think there's still a lot of decent examples of upside potential, a fair amount of uncertainty, specifically around AI. There's been beneficiaries where we've seen, unbelievably high moves, not only in the valuation, but actually in the revenue that they've managed to generate. But that's not the story across all AI-related tech stocks and beneficiaries. Some are yet to monetize their sort of offering. So one's really got to look at, and I think take the time to look under the hood and decide relative to its current valuation whether there's still upside or it's time to head for the doors.
Yeah, I'm going to come back to AI and the whole chip story just now. Devin, I want to come to you. Do you think that there are tech stocks that you could pop the bubble on at this point, or you're happy to just sit back and watch them fly as much as they have been, at least for a while?
Yeah, look, it's a very difficult space for investors, isn't it? Because you've seen such value creation in a very narrow end of the market, and whether you believe in the investment case of those few stocks or not, it's very difficult if you haven't been invested or been underweight to kind of watch them go up on the sidelines. So the more they go up, the stronger that temptation is to jump on board and just ride it at any cost. But I'd kind of echo what Nick was saying to a degree, is that you really got to drill down and understand, these individual company fundamentals. And I mean, Nvidia has been the poster child of this rally, and you could argue with a lot of merit, but you know how much future growth is being priced into today, how many of their clients will turn to become competitors in time and, start manufacturing their own chips. So I think you've just, while the music might play for a while longer and we might still have a, continued rally from here, I think you've just got to understand that there is downside risk, and there are possibly other ways to play the tech bubble. There aren't 7 stocks in there. There's really a myriad of them, and a lot of them have been overlooked. And I think there's a great opportunity for active investors to really go delve into those. And I think you've started to see the signs of that broadening out start this year with some of the other related, chip shares, and as an example, starting to catch some buying interest. But yeah, definitely one you've got to keep your senses about and not just rush in blindly, I would advise.
Yeah, well, let's talk about those chip shares, because the chip war between China and the US rages on. We did get an announcement that official government institutions have been told to stop using PCs that have chips from Intel and AMD. Nick, is there any real concern on some of these chip stocks and the possible hit that could come from that?
Certainly. I think you need to look no further than most Chinese listed equities to realize that geopolitical concerns and the threats between US and China, it's a real thing. And certainly there's a lot of investors that are sitting on the sidelines waiting for it to either blow up or to sort of calm down. So it is something I think one's got to be, keep an eye on, and it is certainly a concern. At the end of the day, one's then got to have a look at, we don't only have to look at technology stocks, but just have a look at how many Western stocks, let's call them Western, US generally listed stocks, do business in China. And it has been historically seen as a bit of a growth vector. Suddenly with a bit of a, let's say, slowdown, although it's still relatively robust growth in China, combine that with geopolitics, we've seen a lot of those stocks sort of run foul of their expected growth rates. And certainly a lot of concerns around what actually happens in these sort of trade wars between these two large powers.
Yeah. As we're talking about China, there's a question on Alibaba. I'm looking at Alibaba and Nike as potential buys. Both stocks seem to show good value at current levels. However, in both cases, there is uncertainty about future growth to drive the share price. Thoughts on these two stocks as potential buys? Let's start off with Alibaba, Devin. Yeah, actually, there have been quite a few analysts that have been picking it as their stock pick, saying that it's showing deep value. What do you make of Alibaba? Could it be a buy at this point?
Look, Zenati, I think if we pull the lens out for a second, I think if you look at Chinese equity and Chinese tech equity more specifically, there's no doubt that it's fallen out of favor with the global investment community. If you kind of look at comparable companies that are listed in the US, they're commanding much higher valuations. You could make the argument that it's rightly so that the kind of investor environment in China is very unfriendly, and I would agree with that to a point. And the economy does have some structural issues, particularly in the property sector. But what you are seeing is that these tech companies, and we'll put Alibaba in there, have just been completely unloved. And I would make the case that probably pushed to valuations below what they should be. So I think at some stage, should that investor sentiment turn, and that will probably start with local kind of Chinese domestic consumer sentiment, I think you could see quite nice moves to the upside on those. But the risk remains that the government still remains investor unfriendly. Policies are somewhat confusing, and not enough stimulus gets put into the economy, and they just kind of muddle along. My sense is that they at some stage are going to be looked at as tech alternatives, maybe still carry somewhat of a discount to their US peers, but I think someone like Alibaba is well positioned, should that play out, to benefit from it.
Okay. So, yeah, you're saying that, if you're betting on a turnaround, short, but I do sense caution in there as well, Devin. Nick, on your side, what would your tone for Alibaba be?
Yeah, so fundamentally, I think I agree. I think there's significant value there in the medium to longer term, right? So that's the idea that the bigger issue is what is going to be the catalyst for turning that around in the short term. Operationally, these companies have done a lot to turn their sort of, let's say, turn themselves around somewhat in a weakened macro environment. However, that has not been reflected in their sort of share price at all. So we might find a scenario where I think if you're a sort of medium to long-term investor, you're going to come right at some point, or we're sort of entering World War III type of scenario, in which case it's going to be the least of your problems. But I'm not sure whether it's going to happen tomorrow, whether it's going to happen in 3 months, 12 months, 18 months, 2 years. So, until it starts turning around and there's more investor appetite for these sort of shares, the share prices can continue to go down. So it's certainly not a short-term trade, but on a medium to long-term basis, undeniable value in these assets.
What about Nike? Interestingly, there was a clip that we saw earlier on that said that the German national team has now switched its sponsor from Adidas to Nike. Just a fun fact there. But Nike, Devin, would you be seeing it as a buy or something else?
Look, I mean, it's a company that we followed closely and we have invested in over time. It has actually struggled a little bit lately, but I think that direct to consumer online model will continue to bear fruit. I think in the recent results, what was a disappointing area was China. They also had some inventory issues. And then I think also their running shoe category, they've lost some market share there. So I think, not plain sailing, but I think when you've got a company that, if I'm not mistaken, control about 60% of the footwear globally for sports, I think it's very difficult to unseat them totally. And I think for the long term, this is definitely one to look at.
I hear you on, the fact that it's not plain sailing. Could it be a plain running? Nick, what do you make of Nike's kind of growth potential at this point?
Yes, I think, first of all, one's got to have a look at their stated strategy for how they retain their market leadership. And decide whether or not that's a good strategy. In my view, it is a good strategy. I buy into that strategy. I think they're executing on it actually quite well. However, you then got to take in, shorter term macro kind of issues. The fact that they are the incumbent, they are the largest, and ultimately there's always going to be some issues, specifically around that, a new sort of strategy going through to the market. Again, it's one of those where I think there's probably shorter term. I would say that there's potentially more pain to be felt in the short term. However, if I was looking with a medium term sort of investment time horizon, I think there's a lot of value right now. Short term, I think, there's a lot of uncertainty. Geopolitics, China's been kind of mentioned on that sort of side as well. So it might struggle slightly in the short term. But there is value there, and on a medium long term, it's a fantastic company, and certainly one that should be in your offshore kind of portfolio. It really does tick a lot of boxes.
Tick. I got you there, Nick.
And Zenati, just flippantly, if the shares are at $90, they're cheaper than an actual pair of Air Jordans, and they'll probably be better for you in the long run. So yeah, go for it.
Wow. Let's get into more questions on Life Healthcare. Is it advisable to put a large sum capital into Life Healthcare Group since they will be paying a special dividend? Has it not been paid yet, Nick?
I'm not sure, to be honest with you. Ultimately, what I would say for any sort of dividend that's coming through, you'll get the cash back as the dividend, but the shares will reprice based on that dividend. So, naturally, you don't necessarily sort of make an investment call. Oh, I wouldn't make an investment call just to try and sort of generate the cash flow up, because the share price will derate in the back of it.
All right. I hear you on that. Just on a fundamental level, Devin, everything included, would you be putting in a large sum of money into Life Healthcare, or would that be maybe a little bit risky?
Yeah, from a portfolio management perspective, no, I would definitely, size it along with many other companies and many other sectors to balance out the risk, because you just don't want to carry very concentrated single company risk. I think if you have to look at life healthcare as itself, we're not that constructive on it. I mean, they have seen nice increases in their patient days recently. Margins are starting to come back, but these businesses have very high capital demands, and there's a lot of technology that goes into running hospitals, a huge amount of expenses, and so sometimes that profitability does come under pressure when the demand isn't there. So yeah, it's something we watch, but yeah, life healthcare is not at the top of our list for adding to portfolios at the moment.
Well, something that the viewer has noticed that is not at the top of the list for investors is Sunlam. It plunged in the last 3 months. Is it a hold? The last results were pretty good. Nick, what would you say about Sunlam? Would you still put it in the unloved category or not?
Well, I think like most financial sector assets in South Africa, they're not trading at premium valuations any longer. And underlying that, I think Sunlam actually has, delivered some pretty decent set of results more recently. And it's a company that certainly I think actually is undervalued. Again, like a lot of our financial sector assets in general, it's certainly one that I would have in my portfolio. I do think you've got a certain amount of growth potential there with their sort of move into Africa, but obviously aligned with that comes an extra amount of risk as well. So one's got a price for that opportunity. So that's something to take into consideration. But Sunlam's one I like at the moment. I think it's it's at a fair to undemanding valuation. So certainly good quality asset, and yeah, I like it.
All right. Devin, on your side, are you in it? And if you are in it, would you be holding it?
We don't currently own it, but it's a solid proposition. I mean, you're talking about the largest financial services group on the continent, non-banking. And yeah, I'd agree with Nick, the valuations aren't demanding. They've seen some nice new business flows come in, and I think there's definitely a space for it in portfolio. So if the listener does have it in there, I don't see any reason to sell.
Yeah, all right. Talking about financial services, there is a question on the Standard Bank, a comment on how we saw it plunge after the results that it posted, what was it, 2 weeks ago. And Nick, do you think Standard Bank has somewhat lost steam, and what that would be a function of?
No, so I don't think so. I think they came up with excellent results. I suppose a little bit of the forward guidance kind of gives you, not areas of concern, but it's certainly, I think the best is probably behind it for the short to medium term. And yet that wasn't really reflected accurately, I think, in the share price, right? So the shares never got expensive on the back of these sort of great set of results. So to now sort of derate when things are going to get slightly worse, I suppose, makes them still just cheaper. Ultimately, it's a problem that I think we face in South Africa through a multitude of our different assets, is that we really are trading almost like Chinese equities, perhaps not as cheap as Chinese equities, but we are an unloved sector and an unloved area of the world at the moment. So everything listed in South Africa that does a fair amount of business here is off from its historical averages, let's say, in terms of valuation, pretty significantly. So really, it's almost more of a macro and investor sentiment kind of issue rather than the fundamentals of the company. I think Standard Bank is well run. I think they've got good growth assets and a good sort of blend of assets. And so ultimately, I like it. And if it gets cheaper, I'll acquire a little bit more. But certainly, again, it's not necessarily a short-term fix, because I can't see what the catalyst is for this immediate turnaround, I suppose, in South African investor fortunes based on investor sentiment, let's say, globally.
Yeah, quite interesting, because the banking sector really has seemed loved but unloved. Devin, which train would you be following here on Standard Bank?
Yeah, look, it's one we like as well, and I think those results were good. It's them along with FirstRand are probably the real strongest in the sector at the moment. Nedbank and Absa, for various reasons, have struggled somewhat. I think also there are some macro headwinds for SA Inc. stocks and our bank stocks in particular leading up to the local elections. I think that's simply an event, and the risk that potentially will come from that will possibly depress valuations for a while. I think operationally they're doing a lot of really good things, and as Nick mentioned, there's some nice growth vectors in the business, particularly in Africa, even with the risk warning that can come with. Ask MTN about that. But yeah, I think they're executing well. I think the dividend payout's still looking really healthy. Nice diversification across Liberty and Stanlib, and yeah, one we think warrants a look at for investors.
Well, thank you for this content, Devin, because you talk about MTN. Let's stick with MTN and with you. Of course, we have this devaluation of the Naira, where now Nigeria has got into a loss-making position. We did see more than 70% plunge in those headline earnings per share. Yeah, is Nigeria at this point kind of a double-edged sword? What do you make of it and its impact on MTN and also MTN's investability?
Yeah, it's really so tough, isn't it, Zanati? They've struggled with that Nigerian operation for many years through, the clampdowns and taxes and licensing and a whole lot of things. And the Naira devaluation is just another, chapter in that saga. I mean, it wiped out about, I think it was about 20 billion of earnings, as you mentioned, giving you the 70% plunge there. And that was pretty much their earnings for the whole of last year. So, they managed to grow some other areas of the business and report some profit for the year, but it really was a kind of a punch in the gut. And, does the Naira strengthen from here? Do they reverse out some of those and, manage to upstream profits back to the head office? I hope so, but I don't think that's guaranteed. And I mean, if you just look at Nigeria as an investment destination at the moment, after being the largest and leading economy in Africa for a couple of years, really given up that place through policy missteps. And yeah, it's just a very, very difficult operating environment, and MTN's at the sharp end of that.
Yeah. I was quite surprised by the fact that investors didn't punish MTN stock today. It was up slightly, about 2%, unless, Nick, all of that had already been priced into the stock before.
I don't think it's all priced into the stock, at least not a worst case scenario. At the end of the day, the most important driver in the short term for MTN is actually Naira, against the currency. So we go back, really, the central bank sort of changed it to more of a floating sort of currency, probably in May, June last year. I think it was trading at about 490 Naira to the dollar at that point, topped out at like 1600. And certainly before that announcement, we knew that the Naira was too strong. It was an overvalued kind of currency. I think we were sort of anticipating that, 600, 700, that was on the horizon. Suddenly it blows out to 1600. They make one or two sort of changes last week, and suddenly the Naira comes from 1600 back to the 1350 odd kind of level. So, its visibility on that currency is at the moment very opaque. Yeah. There is no visibility. And for that reason, it's a very brave investor that makes a call on what the longer term valuation for these assets are. Operationally, I think they're good assets. They're actually doing pretty well in Nigeria. And it's an attractive market. It's just the translation. But from having no clue that we're getting to 1600, if you suddenly told me that we're at 3000 in a year's time, I would probably believe you the same amount I believe the current level at the moment. So I've got no certainty on it, and it could be a proper issue for MTN shareholders in the short term, but it could also get better.
Yeah. All right. Well, let us go to what you're picking for today. Coming to you, Devin, what is your stock pick?
Yeah, I'm going local today. SA Inc. stocks, as we were chatting about a little bit earlier, are generally on the main incredibly cheap, but there is a lot of risk attached to them because of the macro environment. So our sense is you've got to buy the strongest in the sector. So we're looking in the industrial sector, a company called Hudeco, and they've really been one of the most consistent and probably financial strong operators in that sector. They supply industrial, automotive, and electronic consumables, mostly into the South African market. I think what we like about them, financials look really strong, nice balance sheet, good cash flow generation. They've got nice pricing power on the brands that they import, so they're able to weather some inflation. And their business model now is really growing by acquisition, so they're picking up some of their struggling competitors, and we see at a kind of a 7 earnings multiple some nice upside from here.
All right. Nick, what are you making a call on today?
So I'm going offshore. I'm going into technology offshore, and one of the Magnificent Seven, to give you an idea that I don't believe the bubble is over in that sort of sense, I'm going for Amazon. It's a company that I think has been historically grabbing a lot of market share, but generally not that profitable other than in their cloud sort of business. And I think under the new leadership of Andrew Jassy coming across from the cloud business, which is a very profitable enterprise, I think there's certainly much more of a clear driver towards just trying to take revenue and market share. They're moving away from that, and I think they're moving towards profitability. So I sort of anticipate they can grow earnings at least 30% a year for the next 3 years. And it's not on a demanding kind of valuation relative to itself and even relative to other sort of tech companies that are out there. So that is my stock pick. I still think there's a lot of juice left in that sort of stock. And, it's not even close to bubble territory for Amazon at the moment.
Yeah, all right. Well, thank you so much, gents, for your time and for your analysis today. Really appreciate it. That's all for tonight's Stock Watch. Thanks to our guest, Devin Shutte from the Robert Group and Nick Crail from FNB Wealth and Investments.